The year 1720 marks the moment when Britain's wealthiest men discovered that paper fortunes disappear faster than morning fog over the Thames, when dukes and earls who had owned estates for centuries found themselves begging for bread in streets they once ruled, when the mathematical genius who calculated the movements of celestial bodies across infinite space lost £20,000 in 8 weeks because he could not calculate the one force that obeys no law. Human madness dressed in the respectable clothes of financial innovation. Isaac Newton sits in his study as September darkness falls over London, surrounded by scientific instruments that measured the universe's secrets, but could not measure his own folly, feeding document after document into the fireplace, while flames consume evidence of the mistake that no amount of genius could prevent or pride could acknowledge. The greatest mind in Europe burns his shame methodically, watching ink and numbers blacken and curl, erasing from history what he cannot erase from memory. The moment he bought South Sea Company stock at £900 per share, while knowing, absolutely knowing with the same certainty that governed his laws of motion, that the price defied every principle of rational valuation. Beyond his window, London writhes in collective agony as Exchange Alley transforms from temple of infinite wealth to graveyard of financial corpses, where men who owned everything 3 months ago now own nothing but debts they cannot pay and shame they cannot escape. The narrow cobblestone passage that once could barely contain the pushing, shouting, frenzied masses of buyers now echoes with a different sound. The silence of ruin, punctuated by occasional sobs from men sitting on cold stones with their heads in their hands, clutching worthless stock certificates that promised empires but delivered destruction. The South Sea Company's stock price, which climbed from £128 in January to £1,050 in September, an ascent so steep it seemed to mock gravity itself, has collapsed to £135, erasing £500 million in wealth that never actually existed, but whose absence creates very real consequences measured in bankruptcies, suicides, families destroyed, aristocratic bloodlines ended not by war or plague, but by belief in promises that were always lies. This is not a story of complicated financial instruments or economic theory beyond comprehension, but rather the eternal human pattern of greed overwhelming reason, of collective delusion masquerading as sophisticated investment strategy, of the universal inability to resist opportunity. When everyone around you grows wealthy, and warnings from careful men sound like cowardice from those too timid to seize fortune's moment. The South Sea Bubble was Britain's first modern stock market crash, the prototype for every financial catastrophe that would follow across 3 centuries, the moment when the pattern revealed itself completely. How bubbles inflate through belief and pop through fear. How insiders profit while crowds suffer. How governments enable disaster, then punish the consequences. How the psychology never changes, even as the specific mechanisms evolve with each new generation's conviction that they have discovered something genuinely different from what destroyed their grandfathers. What follows is the story of how 150,000 British investors, from servant girls to members of Parliament to the King himself, learned that markets can climb for months but collapse in weeks, that everyone believes they will exit before the crash, and that almost everyone is catastrophically wrong. Britain in 1711 stands victorious over France, but drowning in the cost of that victory, crushed under £31 million of debt accumulated through a decade of war that ended with Marlborough's armies triumphant across Europe, but the treasury empty and creditors demanding payment the government cannot provide. The War of Spanish Succession delivered Gibraltar and glory, but also delivered financial catastrophe, with interest payments alone consuming a quarter of annual revenue while the principal remains untouchable, a mountain of obligation that threatens to bury the empire in peacetime after surviving the war itself. Chancellor Robert Harley faces a problem that cannot be solved by taxation or austerity, a debt so massive that conventional solutions merely postpone the inevitable reckoning. And he needs something unprecedented, a financial innovation that transforms liability into asset. that makes bondholders grateful to exchange their secure government debt for shares in a trading company that exists more in imagination than reality. Harley is a survivor of political warfare who understands that crisis creates opportunity for those willing to think beyond conventional boundaries, and he finds his instrument in John Blunt, a man who rose from shoemaker's son to clerk to something far more dangerous, a financial engineer who grasps that money is ultimately belief made tangible, that if you make people believe strongly enough, you can conjure wealth from nothing but promises and paper. Together they forged the South Sea Company in 1711, created by Act of Parliament, with a proposal dazzling in its audacity. The government trades crushing debt for company stock. Bondholders exchange boring guaranteed returns for shares in a trading empire that will dominate the riches of the New World, extracting wealth from Spanish America's mountains of silver and rivers of gold through trading rights granted by treaty. The Treaty of Utrecht gives Britain permission to send one ship annually to Spanish colonies, one single vessel per year. But Blunt speaks of fleets and fortunes and commercial dominance that will make the East India Company look like a village market. And Parliament approves because the alternative is default and disgrace. The company absorbs £9 million of government debt in its first year, with bondholders converting to stock that rises modestly as the company operates actual trading voyages that are small and barely profitable, but real enough to maintain the essential illusion that this is a legitimate commercial enterprise rather than an elaborate mechanism for government debt refinancing disguised as global trade opportunity. Years pass quietly as the company establishes respectability through boring competence, ships sailing and returning with modest cargoes, directors collecting salaries, everything appearing solid and sustainable until John Blunt becomes director in 1718, and within 2 years transforms the company from respectable mediocrity into history's first modern financial weapon. Blunt sees what others miss, that the debt itself is not a burden to be managed, but an opportunity to be exploited on a scale that will dwarf the initial debt conversion. That if the company can absorb all 30+ million pounds of remaining government bonds while simultaneously inflating stock price through carefully orchestrated manipulation, the profits will be extraordinary for those positioned to extract them before the inevitable collapse. His proposal to Parliament in January 1720 promises to convert the entire national debt into South Sea stock, and Parliament should demand proof of actual trading profits, should examine the company's pathetic revenue figures, should ask how one ship per year to Spanish America justifies absorbing a debt equal to multiple years of government revenue, but they don't ask because Blunt has already purchased them. The bribes are elegant rather than crude, fictitious stock granted to key members of Parliament, shares that exist only on paper and cannot lose value because if the stock rises, the politicians profit magnificently, while if it falls, the shares simply vanish with no money actually lost. The perfect bribe that appears to be an investment opportunity rather than corruption. Chancellor John Islaby receives a fortune in phantom shares. The king's mistresses receive substantial holdings. Even King George IV himself becomes a governor of the company with personal financial interest in its success. And when Parliament votes in April 1720 to approve the South Sea Act, authorizing the company to absorb the entire national debt, the outcome was never in doubt, because a quarter of Parliament already depends on the scheme's success for their own enrichment. The stock price begins moving immediately after parliamentary approval, climbing from £128 in January to £175 in February to £330 in March. And Blunt orchestrates every aspect with the precision of a general commanding armies across multiple fronts simultaneously, releasing new shares in carefully timed subscription waves that sell out within hours, lending money to investors so they can buy stock using the shares themselves as collateral, bribing journalists to write glowing reports of incredible profits from South American trade that barely exists, paying prominent citizens to publicly purchase shares while spreading rumors of imminent trading breakthroughs that will justify any price. By June, the stock reaches £890, representing 700% growth in 6 months, and Exchange Alley becomes the center of the known universe, where dukes rub shoulders with servants and ladies in silk gowns trade shares alongside dock workers, where stories spread like wildfire of footmen becoming wealthier than their masters overnight, of 100 pounds transforming into 10,000 in weeks, of fortunes materializing from nothing but the courage to believe and the wisdom to buy. Other companies sprout like weeds, offering schemes even more absurd, extracting silver from lead, trading human hair. One promoter advertising, a company for carrying on an undertaking of great advantage, but nobody to know what it is, that raises 2,000 pounds in 5 hours before he flees to France with the money. But none compare to South Sea, the giant, the government-backed titan that cannot fail because the king himself invested, because Parliament approved, because the company's paper value now exceeds the worth of all land in England combined, and Blunt watches his creation grow beyond even his vast ambitions while knowing that he has built an empire on promises that will eventually require reckoning, but not yet. Not while belief holds and prices rise and everyone grows wealthy on paper fortunes that feel absolutely real. Summer 1720 arrives and Britain collectively loses its mind as the stock shatters 900 pounds in July, then 950, then the psychologically impossible barrier of 1,000 pounds per share, a price that makes no mathematical sense whatsoever. But mathematics cannot argue with the physical reality of servants making 3,000 pounds in a week, more than a lifetime of wages, and purchasing small estates while their former employers, paralyzed by caution and prudence, watch their coachmen become wealthier than themselves. Exchange Alley no longer functions as a street, but as a temple where skeptics arrive and believers leave, where the narrow passage between coffee houses can barely contain the masses who shout bids over each other's heads from dawn until midnight in a roar that never stops, a continuous thunder of buying and selling and promising and dreaming that sounds like madness, because it is madness. But madness that pays magnificently for those who participate while punishing those who stand aside with the agony of watching others prosper. John Blunt stands at the storm's center with the calm of a chess master surveying a board where every piece moves according to his design, having achieved something unprecedented in financial history. Not merely wealth, though his personal fortune climbs into millions, and not merely power, though he commands more influence than most cabinet ministers, but rather the transformation of belief itself into currency, where the South Sea Company no longer needs actual trade because it profits from the simple act of existing, with each new subscription selling out instantly as investors beg for the privilege of paying higher prices than the previous wave. The fourth subscription releases in August at 1,000 pounds per share, the highest price yet, and sells out in 3 hours as the company's market value reaches 200 million pounds, twice Britain's entire money supply, 3 times the value of all currency in circulation, more than the gross domestic product of the entire nation. And mathematicians publish warnings in newspapers explaining with irrefutable logic that the numbers make no sense, that the company cannot possibly generate profits to justify these valuations, that basic arithmetic proves the structure must collapse. But nobody listens because everyone knows someone who became genuinely rich, knows real people with real gold in hand transformed by real stock certificates, and mathematics cannot argue with lived experience. Parliament passes the Bubble Act in June, making it illegal to form new joint stock companies without royal charter, and Blunt pushes the law through personally not to protect investors but to eliminate competition, to make South Sea Company the only game in town, and when 80 companies shut down overnight, their investors flood into South Sea shares in the last great surge that pushes the stock to 1,050 pounds on September 1st, 820% growth in 9 months. The greatest financial ascent in human history, and Exchange Alley erupts in celebration, with champagne flowing and men embracing strangers and fortunes made in hours and futures secured in minutes. Thomas Guy, The bookseller who invested early and sold everything at the peak walks away with £234,000 in profit that he will use to build a hospital bearing his name, a hospital still standing 3 centuries later as monument to the man who saw what others refused to acknowledge, that the peak had arrived and anything after would be descent. But for every Thomas Guy exercising discipline and wisdom, 1,000 others mortgage estates and borrow against future inheritances and sell everything they own to purchase more shares because the line only goes up. Everyone knows the line only goes up, and only fools stand aside when fortunes materialize daily for those brave enough to believe. Isaac Newton watches from his study, having invested early and made £7,000 profit and sold in spring with rational discipline and perfect timing, then watches servants become richer than professors and fools prosper, while wise men stand aside and the entire world reward madness while punishing caution. And the greatest mind in Europe cannot resist the psychological torture of being right, but poor while idiots grow wealthy. So Newton buys back enduring summer near the peak, purchasing £20,000 worth of shares at £900 each. And if genius itself succumbs, then who can possibly blame the common man for following where brilliance leads? King George I counts his paper fortune and plans grand projects with wealth that exists entirely in shared delusion, while Chancellor Aislabie congratulates himself on solving Britain's debt crisis through innovation rather than painful taxation, and over 100 members of Parliament calculate their gains with a quarter of Britain's government personally profiting from the scheme. And nobody wants to ask the dangerous question that has no safe answer. Where does the money actually come from when the company has no profits and pays dividends from new investors' subscriptions? When each wave of buyers pays the previous wave? When the system functions only as long as new believers arrive with fresh capital? In coffee houses, whispers begin quietly enough to ignore that directors are selling, that Blunt himself has converted vast stock holdings to government bonds, that the men who promised unlimited wealth no longer believe their own promises. And September 1st remains the peak at £1,050, but September 2nd closes at £1,040, just £10 lower, normal fluctuation, nothing concerning, except the stock doesn't rise on September 3rd or September 4th. And by September 10th it sits at £950, still representing massive gains for early buyers, but no longer rising, and in a system built entirely on belief that numbers only ascend, the moment they stop climbing becomes the moment they start falling. September 24th, 1720 arrives, and the coffee houses of Exchange Alley open to a different atmosphere entirely, where the triumphant roar has diminished to anxious murmur, and men gather in tight clusters speaking in hushed tones rather than shouted bids. And someone claims they saw John Blunt's broker selling not a small position but thousands of shares, and it's probably just rumor, almost certainly exaggerated, except the whisper spreads through the crowd like fire through dry timber, and by midday the price slips to £850. The number itself remains magnificent by any historical measure, with investors who bought in January having sextupled their money and having no rational reason for concern, except that direction matters more than distance in a mania where every dip recovered within hours for 9 months straight, training investors like dogs to a bell that hesitation means missing profits. So buy immediately, always without question. And now the pattern that trained them breaks, and they don't know how to interpret downward movement that doesn't immediately reverse. September 28th opens at £780, and the whispers become shouts as evidence mounts that directors are selling not just Blunt, but all of them, that the men who promised limitless wealth are converting their shares to bonds and gold and anything solid and permanent, and the believers panic first. The recent converts, the servants and shopkeepers who mortgaged everything to join the miracle in its final weeks, who bought at 900 or 1,000 and now watch their shares sink underwater, their collateral evaporating, their borrowed money coming due with no way to repay except selling shares that fall further with each sale. October 1st sees £700, and the mathematics that investors ignored during the rise become impossible to deny during the fall. The simple arithmetic showing that the company's dividends were never real, that South American trade barely exists, that the Spanish control the ports, and the Treaty of Utrecht permits one ship annually, one pathetic ship that returns with modest cargo, nothing remotely justifying a valuation that exceeded Britain's entire economic output. The company has no business, never had business, had only belief, and belief, once cracked, shatters completely and cannot be restored no matter how desperately directors announce new subscriptions at favorable terms or proclaim their continued faith or beg existing shareholders to hold because nobody believes anymore. October 3rd brings £650, and the holders who bought on credit face catastrophe first. The investors who borrowed from the company itself to purchase shares using those same shares as collateral. Brilliant leverage when prices rose, but lethal now as margin calls arrive demanding immediate repayment. Investors cannot pay, so they must sell shares to cover loans, but their selling pushes prices lower, which triggers more margin calls, requiring more selling, which lowers prices further in a death spiral that feeds on itself with mathematical inevitability, accelerating with each rotation until the system devours everyone caught in its mechanism. Men who owned estates on paper now owe debts measured in years of income they'll never earn. The coachman who bought his small manor faces ruin. The widow who invested her husband's legacy watches it evaporate. The merchant who borrowed against inventory to buy shares at £1,000 now holds paper worth half that and debts worth double. And October 10th arrives with £500, and Exchange Alley transforms from temple to graveyard where hollow-faced men stand in small groups discussing not profits but survival. How to explain to wives, how to tell creditors, whether exile might be preferable to debtor's prison. The company directors vote in emergency session to suspend dividend payments, the final admission that profits never existed, the ultimate confirmation that the entire structure was sandcastles on a beach with the tide coming in. And October 22nd sees £400 as Parliament begins to stir with members who profited magnificently watching their gains dissolve, while more concerning their constituents face ruin. Voters who praised representatives for supporting the South Sea Act now gather in angry mobs demanding answers and accountability and punishment. November 15th brings £135, and in his study, Isaac Newton watches his £20,000 investment become worthless, and he does not shout or weep, but simply gathers every document related to South Sea Company, letters, certificates, calculations, and burns them methodically in his fireplace because he will never speak of this again. And the crack has become chasm, and the chasm has become abyss, and the fall has only begun. November 1720 arrives, and Britain tears itself apart as the stock sits at £135, having lost 88% of peak value, erasing £500 million in wealth that was never real, but whose absence creates very real consequences for the hundreds of thousands who borrowed real money and made real promises based on paper valuations that have dissolved like fog, leaving behind only the debts and the obligations and the creditors demanding payment that cannot be given. The Bank of England watches the carnage with cold satisfaction as their Whig masters see political opportunity in Tory catastrophe, Chancellor Lobby bleeding from self-inflicted wounds while his allies abandon him, and enemies circle like sharks, scenting blood and water. But the bank miscalculates catastrophically, because this is not merely political crisis, but systemic collapse that recognizes no party loyalty and respects no institutional boundaries. Banks that lent money secured by South Sea stock find their collateral worthless and demand repayment from borrowers who cannot pay, and the banks fail. 3 major London banks closing their doors in a single week as depositors riot in streets, smashing windows and demanding their money that no longer exists, that never existed except as accounting entries based on valuations built on shared delusion. The goldsmith bankers who financed trade throughout the empire face runs as merchants who stored capital in their vaults arrived to find locked doors and empty rooms, and their life savings vanished, and commerce grinds to halt with ships sitting idle in harbors because no one can finance cargo and factories closing because owners cannot pay workers. And the South Sea Company has poisoned the entire financial system, spreading contagion through every institution connected to credit and trust, and the assumption that paper promises represent actual value. Parliament reconvenes in emergency session. December 8th, and the mood is murderous as members who profited now perform outrage for constituents who lost everything, demanding investigations and trials and executions, with the fury of the guilty trying to appear innocent through theatrical displays of vengeance. Robert Walpole stands to address the chamber, having opposed the South Sea scheme from the beginning, and now seeing his moment arrive, speaking with calculated calm about finding truth and identifying the guilty and ensuring accountability. And the chamber roars approval. But Walpole knows what the angry mob does not: that too many powerful men profited, that the king himself holds stock, that a quarter of Parliament received bribes, that if investigation goes too deep, it will destroy the government itself and potentially the monarchy, that he must satisfy public rage without toppling the system entirely. The parliamentary inquiry begins in January 1721 with the secret committee, they actually call it that with no irony whatsoever, investigating the company's books and discovering fraud exceeding even the darkest suspicions, finding that official trade generated £17,000 profit over 9 years, 17,000 total, while the stock market valuation reached £200 million at peak, meaning the gap between reality and fantasy measured 99.9%. Nothing but air and promises and lies. The committee discovers the fictitious stock scheme with shares granted to members of Parliament and ministers and royal mistresses that existed only on paper, bribes disguised as investments, over £574,000 distributed to government officials who voted to approve the scheme while personally profiting from its success. Names emerge in testimony and documents that cannot be denied or explained away. Chancellor Aislabi with massive holdings, Charles Stanhope, the Secretary of the Treasury, enriched spectacularly, James Craggs, the Secretary of State, taking bribes worth thousands, the Duchess of Kendal, who is the King's mistress, receiving shares worth tens of thousands and selling at the peak while common investors died. And the evidence is overwhelming, and the corruption total, and Parliament explodes in fury, with one member shouting that parricide and murder are innocent compared to this, while another demands the directors be sewn into sacks and thrown in the Thames, the ancient Roman punishment for patricide. The directors are summoned one by one to face the committee, and John Blunt arrives calm and impeccably dressed, answering questions with precision while admitting nothing and explaining less, too clever for direct confession, restructuring every question and deflecting every accusation. But the numbers do not lie, and the committee traces £2 million in direct fraud that simply vanished from company accounts into private hands through bribes and payoffs and theft. Chancellor Aislabi cracks first, tried before the House of Lords and found guilty of corruption and stripped of office and expelled from Parliament and sent to the Tower of London. Not symbolic gesture, but actual imprisonment in the fortress where traitors rot. And the crowd cheers his arrest as finally consequences for the powerful who destroyed the poor. James Craggs, the Secretary of State, faces similar charges but dies before trial, officially from smallpox, though whispers speak of suicide and poison and shame, and his father, James Craggs the Elder, also implicated, dies the same week in convenient deaths that prevent testimony from implicating higher powers. And the king's name hovers over everything because George IV profited enormously, and his mistresses enriched themselves, but no one dares speak it directly because accusing the monarch means treason. Walpole manages the crisis with surgical precision, punishing enough men to satisfy rage while protecting enough men to preserve the system, achieving the delicate balance between justice and stability that allows government to survive catastrophe. The company directors face the harshest punishment through a bill of pains and penalties, a law targeting specific individuals without trial, medieval justice for a modern crime, and their estates are confiscated, their wealth seized to compensate victims, and John Blunt loses almost everything. His vast fortune built on genius and lies and understanding human weakness better than any man alive now stripped away, though he escapes prison because his connections, even in disgrace, protect him. And he retreats from London to live in reduced circumstances and die 13 years later, disgraced, but free. And it is not enough. Not remotely enough. 150,000 investors lost everything, families destroyed, fortunes dissolved, lives ended, and the compensation from seized estates returns pennies on the pound, with investors who lost £1,000, perhaps recovering 30 or 50, but never close to whole, never enough to restore what was taken. Never sufficient to rebuild what was destroyed by men who understood exactly what they were doing and did it anyway. Because the profits were extraordinary, and the consequences were always going to be someone else's problem. December 1720 settles over London like a burial shroud, and the physical city stands unchanged with the same streets and buildings and Thames flowing cold and gray through the heart of empire. But the city itself has died in some fundamental way that transcends physical architecture, visible in the empty coffeehouses that once overflowed with frenzied traders and now host only whispered conversations among the few who still venture out. Visible in Exchange Alley sitting nearly deserted, where months ago bodies packed so tightly that movement required shoving through human walls. Visible in the faces of men walking streets with eyes that have seen their entire world unmade and don't know how to construct a new one from the ruins. Walk these streets and the human cost of numbers becomes inescapable. The merchant who hangs himself in his counting house after borrowing against his business to buy shares at £900 that are now worth £130 while the debt remains £900. His family finding him at dawn still swinging from the rafters. And he is not alone. Not remotely alone, as suicides spread through December like plague with men who cannot face their wives and fathers who cannot explain to children why the grand house must be sold, and why the servants must be dismissed, and why they will now live in rented rooms eating cabbage and bread, some choosing the rope and others choosing the river. The Thames claiming bodies throughout the winter as men in fine coats weighed down with stones sink into dark water rather than face dark futures. The debtors' prisons overflow with Marshalsea and Fleet and King's Bench, designed to hold those who cannot pay their creditors, now housing thousands who are not criminals or thieves, but investors. Men who believed promises and trusted their government and thought that genius itself represented by Newton's investment validated the scheme. And inside these stone fortresses, nobles sleep on straw alongside shopkeepers. Former estate owners share cells with former servants because the bubble made no distinction between classes on the rise and makes none on the fall. Families disintegrate under the weight of debt and shame, with wives leaving husbands who lost their dowries, children sent to live with relatives or apprenticed out or simply abandoned, marriages dissolving because these were not poor men hoping to escape poverty, but successful men who had achieved security and risked everything not from desperation but from greed. And the shame proves unbearable. Thomas Broderick, Member of Parliament for Stockbridge, loses his entire fortune and writes to a friend that he is undone beyond redemption, and his family faces beggary, and he cannot show his face in society, and death would be preferable to this humiliation, and he does not kill himself but never fully recovers, his health collapsing and dying within 2 years aged 46, broken by disgrace as much as poverty. The aristocracy suffers spectacular falls, with the Duke of Portland losing £40,000 and the Duke of Chandos seeing his fortune cut by 2/3, forcing him to sell his famous estate at Cannons and dismiss his private orchestra and abandon his architectural projects, transformed from patron of the arts to debtor in months. Though the aristocracy has resources in family connections and estates that cannot be seized, so they suffer but survive, while the middle class has no such cushion. The lawyer who invested his savings loses everything. The merchant who borrowed to expand his position faces debtor's prison. The widow who trusted company promises to secure her children's future now watches those children go hungry. And 150,000 investors discover that most will lose everything, or nearly everything, while compensation schemes provide cold comfort, with Parliament authorizing payments from seized directors' estates through a process taking years, and when payments finally arrive, victims receive perhaps 30% of their losses, if they are fortunate, while many receive nothing at all. The company itself survives barely, restructured and reduced and stripped of its monopoly and pretensions, continuing to operate for decades as a ghost of its former grandiose self before eventual absorption into the British government's debt machinery, a monument to hubris that stands as warning no one heeds. The Bank of England emerges stronger because the crisis proved the necessity of stable government-backed institutions, and the bank's conservative approach mocked during the Mania now appears wise, and Robert Walpole ensures the bank's position becomes unassailable while using the disaster to build his political dominance as the Whigs consolidate power on ruins of Tory credibility, since the South Sea Company was a Tory scheme whose collapse destroys the party's reputation for generations. But the deepest fall is cultural rather than financial or political. The death of trust that made Britain believe in markets and innovation and financial engineering as solutions to problems that taxation and discipline could not solve. And the trust dies in 1720 with consequences lasting a century as British investors avoid stocks and buy land and government bonds and tangible assets they can see and touch, with the stock market becoming a backwater for speculators and fools. The Bubble Act passed during the Mania to eliminate competition remains law until 1825, strangling innovation in the crib for over a century because Britain learns the wrong lesson. Not to regulate speculation, but to avoid it entirely, becoming conservative and risk-averse and traumatized. An empire that once embraced financial innovation now fearing it above almost all other dangers. Isaac Newton dies in 1727, 7 years after the crash, with his scientific legacy secure through laws of motion and calculus and understanding of light and gravity. But he never speaks of South Sea again to anyone, destroying evidence and burning letters and erasing months from his papers through deliberate silence where confession should exist. Because even in death, Newton cannot admit the folly, cannot acknowledge that the man who calculated the universe could not calculate himself, could not solve the one equation that matters most, the mathematics of human weakness in the face of collective delusion and the eternal inability of even genius to resist madness when it wears the mask of opportunity and everyone around you grows rich while you stand aside with only your principles and your loneliness. 300 years separate us from Exchange Alley's collapse, yet the pattern remains unchanged across every generation that believes itself immune to history's lessons. Wall Street 1929, the dot-com peak of 2000, the housing bubble of 2008, the cryptocurrency mania of 2021. Each crisis arrives wearing different clothes but speaking the same language of greed disguised as opportunity, of warnings dismissed as pessimism, of those who see the cliff yet cannot stop running toward it. The South Sea bubble was not a failure of mathematics but a failure of courage, the eternal human inability to stand apart while others grow rich, even when reason screams that the wealth is phantom and the reckoning inevitable. Isaac Newton understood gravity's laws perfectly, yet bought at the peak anyway, not because his calculations failed, but because watching servants become wealthier than scholars proved unbearable, because loneliness weighs heavier than logic when everyone around you prints money from belief alone. The aftermath brought reforms, disclosure requirements, fraud prosecutions, regulatory frameworks designed to prevent repetition, and every subsequent bubble has added more rules, more oversight, more safeguards that fail with reliable precision because regulations constrain actions while human nature remains untouched and untamable. Knowledge of the pattern provides no immunity from its pull. which is why Newton spent his final years burning evidence and refusing to speak of his loss, why the smartest minds in every generation fall prey to the same delusion, why 3 centuries of warnings go unheeded not from ignorance, but from the terrible hope that this time, somehow, will be different. The South Sea Bubble's legacy is not the century of financial caution it created or the regulations it spawned, but the proof that humans cannot calculate the madness of crowds, even when we know precisely what comes next. Even when history hands us the script and shows us the ending, even when the cliff's edge is clearly marked and brilliantly lit. The next bubble is already forming, and we will participate anyway, because we are human, and humans never learn.